Welcome everybody to day 2 of CPA Assembly Week. We're happy to have you back. For today's session, we have Secretary of Finance Aubrey Layne, and he is coming to talk to us a bit about the CARES Act and the Consolidated Appropriations Act and how they're affecting tax conformity here in those ongoing conversations. So again, if you're just joining us, I'd like to ask you to go ahead and mute yourselves so that we can minimize the background noise. If you have questions as Secretary Layne is speaking, you're welcome to put those in the chat, and then we also will be able to open things up at the end for additional Q&A. And with that, I will turn things over to you, Secretary Layne. I'll be handling your slides, so just let me know when you're ready to move on to the next one.
Well, thank you, Emily, and thank you to the members here for having me on today. I should mention, I think also joining this call will be Deputy Secretary June Jennings, and our over in tax, we have Kristen Collins will be joining us. So if there's any questions, we'll have people here to answer them for you. What I thought I would do today, just give you, and you guys probably know it better than I do, a brief overview of the CARES Act and the Consolidated Appropriations Act and how the state has approached conformity. We do know both these acts have significant tax provisions. And we also know this year for conformity is going to be complicated. When I took over as Secretary of Finance 4 years ago, one of the things people told me was, oh, this conformity is really easy. It's a pretty perfunctory bill that comes through every year, and you don't have to spend any time on it. Of course, that has totally not been the case with the Tax Cuts and Jobs Acts and all the things that have been going on. And certainly not the case this year with these two stimulus acts that came out. Complicating it even further, the Consolidated Appropriations Act wasn't formalized until December 27th. So that impacted the way the Commonwealth it does its revenues projections, which I'll get into. But I wanted you, the members, to know, I understand it's going to be complicated. Getting something certainty quickly, I know it's important to you guys. I understand we're still in a tough work environment because we're still social distancing. Even though the vaccination rollout is there, it's still a long ways from getting up to speed the way it should. And infections are still increasing. So we're still, most of us, working from home as much as you guys are. So we understand that, combine that with the new laws. And of course, an added problem this year is the only way to get the correct stimulus funds that you were due last year, if you got the wrong check, is to file your return. So I would expect to have a lot of people wanting to get those filed early. So just to give you just an update of understanding exactly, I think, of what we're dealing with. Next slide, please. All right, so really what I wanted to share with you today are the provisions in both the CARES and the Consolidated Appropriations Act that the Commonwealth has proposed to conform to, and the provisions that it has not. In general, we have tried to conform to the individual provisions, and in general, we do not conform to most of the business provisions in here. And what this slide first does is show you the provisions that we are anticipating to conform to and what the revenue impact is. I should mention, even though sometimes as CPAs we take for granted that the conformity is mandatory, it is not. We do it to help as a convenience. But in terms of the revenues, it is there to support the revenue base, but it's not mandated that conformity is always the position the Commonwealth takes. In fact, if it wanted to, the Commonwealth could have its own set of tax laws. Obviously, we don't want to do that, but I point that out because we somehow default that just because the feds say it, it's what Virginia ought to do, and that's not the way the Commonwealth, from its perspective, looks at its revenue generation and how it should be paid for by the taxpayers. I mention that not to be adversarial, but simply to say it's a different viewpoint of how we look at things here in the Commonwealth. And so as a fiduciary, I may have a different point of view than what many of you as preparers could have in that. But if you go to the third line down where it has the total CARES Act provisions, you can see that in fiscal year 2021, we anticipate about a $34.2 million impact, and in 22, a $7.5 million impact to the individual provisions related to the CARES Act. Now, there's a whole lot more provisions in both the CARES Act and the Consolidated Appropriations Act that I don't have listed. They have minimal impact on our revenues, and so we just default to conform to those. So if you don't see it on here, it doesn't mean that we're not conforming to it. It probably means we are conforming to it, but it doesn't have a significant revenue impact, and therefore it's not listed out. The CARES Act provisions we were very much aware of when we did the budget. The budget for revenues was done back in late October, November, and finalized in December. So we pretty much understood what these provisions would be. We also had guidance from the IRS on how the CARES Act was going to be looked at from the federal purposes. And that's what we use to develop the revenue sources. So the CARES Act impacts were in the introduced budget that the governor put in front of the General Assembly back on December 16th. Unfortunately, the provisions in the Consolidated Appropriations Act were not. And again, you see those provisions listed out here that I won't go through in detail. We can get to answers later, but pointing out most of those are individual provisions or small business that had these revenue impacts, and the recommendation was to conform to these provisions. And so it's roughly about $9 million in 21 and $69.7 million in 22, meaning that we will have to have a budget amendment of about $78 million to reflect the impacts and the revenues of these items. So those are the items, and we can talk in detail after with any question, but I think more importantly is understanding which ones we're conformed to, which ones we're not, and why. And so those are the ones that we are conformed to. Okay, next slide, please. This slide are the provisions in both the CARES Act and the Consolidated Appropriations Act where the governor did not recommend a conformity to the federal law. Primarily, they relate to business, although there's one that when you say business could relate to individuals, and of course the medical expense floor, which I'll get to, is related to individuals. But the three on top related to basically NOL carrybacks, the first two, because of the significant revenue impact, we did not recommend to conform to those provisions. And let me point out, there are three things that Virginia considers when it looks at conformity. Four things, really. Obviously, we'd like to conform as much as possible because that would make it easier for taxpayers and those preparers. However, we do look at the fiscal impact. We do look at tax policy and how all Virginians may be impacted. And of course, we look at equity in that. So those are the items we look at. And primarily, the overriding one is the impact on revenues. I'm just going to be honest with you. The impact on revenues gets a lot of attention from the state legislature, and that's a primary focus, at least on the first cut, of whether or not we conform. And these two carrybacks allow individuals deconforming again from the TCJA, Tax Cuts and Jobs Act, JA, Tax Cuts and Jobs Act, would allow individuals, companies and businesses to take back losses, even though they might not have been impacted in 20, because it also allowed years 18 and 19. So the decision was not to conform to that. In terms of the business interest deduction, as you recall, we partially conformed to that with a 20%. This increased it from 30 to 50%, and we did not recommend conforming to that, quite frankly, because we were already conformed or deconformed at 20%. So you can see, had we taken that into account, in fiscal year 2022, it had been about a $666 million revenue reduction. Now that brings me to the Consolidated Appropriations Act. The two items we didn't conform to, the first one, the extension of the 7.5% floor for the medical expenses. We were already deconformed to that. And then we've had a history of conforming and deconforming. We just left it at deconformity because that's what the General Assembly had done last year. So that's the decision on that one. Of course, the one that has been in the news lately is the deductibility of the business expenses funded by forgiveness by the PP loans and the EIDL loan proceeds. And Virginia has recommended, the governor has recommended we do not conform to that presentation. I got that forgiveness, and it's really based not only on the financial impact, which is great, and you can see the impacts there. And of course, we believe it would be more than that. These are primarily, this program's continuing. The Department of Tax believes we could almost get up to almost $900 million in lost revenue if we did conform to these provisions. And so that is the reason for the reasons why we did not conform to the various provisions you have on this page. Now I'm going to talk a little bit more about the conformity with the PPP loan forgiveness. You can go to the next page, please. Under this, the conformity or the treatment by the IRS has changed over this. I assume some of it was from your advocacy, but as you well know, under most circumstances, loan forgiveness is taxed. And of course, if you have a loan, you can deduct the expenditures related to that. You can't have a deduction if, in fact, you're not at risk for these expenditures. That's the general rule, and I'll go through that. Of course, under the CARES Act, and I'll tell you what, you guys know all this right here. Let's go to the next page, because I go through this, I think it'd be easier to follow with this table, what I'm going through here. So, column on the left is the base treatment for loan forgiveness and the deductibility of expenses. So if you look at the column on the left, if you received a PPP loan of $150,000 and you had expenses of $150,000 that you paid for, you had no cash out of pocket. You would have had to report income if the loan was forgiven, but you could deduct the expenditures. So you had no net tax benefit or curtailment because you didn't have any cash out of pocket either. This is how Rebuild Virginia will be taxed. The grants related to Rebuild Virginia, the small businesses, they have to report that as income. The federal government did not give them exclusion, even though it's federal monies, but they can deduct the expenses. That is typically what happens, and I know you all know that, and I can't cite the exact rule, but it's typically what the default position is for loan forgiveness. And again, the Rebuild Virginia grants that were given to many small businesses fall under this. Then comes along the CARES Act and the PPP loans, and that's column 2. Under the CARES Act, and by guidance we received when we did the budget from the IRS, that the PPP loan again is $150,000. You had $150,000 expenses. Again, no cash out of pocket related to those expenditures. You wouldn't have to report the income, but the IRS position with this was that you could not deduct the expenses. Again, a zero tax curtailment or benefit, and pretty close, same end result, even though they got it in different ways. And that's how the state of Virginia built its budget for the current year, based on that, because we did not get the Consolidated Appropriations Act until December 20th. And by that time, the revenue projections were all put to bed. So we could not anticipate at that time the IRS was going to change its posture related to Congress passing a law. Then the third column comes along is the Consolidated Appropriations Act, which again, same $150,000 on both the loan and the expense, although this time it says you don't have to report income but you can deduct the deductions, and of course you have a tax benefit of $150,000, which causes the significant reduction in the taxable income of the projected revenues for the Commonwealth of Virginia. But more than that, is what got our attention besides the revenues, is there is roughly about $12.6 billion in PPP loans in the Commonwealth. About 113,000 different businesses got these loans. The Commonwealth has somewhere, and a conservative estimate is 250,000 different businesses that pay us withholding and income taxes each year. And it's more than that, because that didn't include the temporary when people come in. Sometimes it's up to 280, but about 250,000, meaning only about 40% of the businesses in the Commonwealth were able to get PPP loans. As you all know, it was first come, first served. Not that those entities didn't need it, but nonetheless, it was not available for everybody. So somebody that didn't get a PPP loan or out of pocket these expenditures, and certainly should get a deduction, but we did not think it appropriate that the PPP loan forgiveness get the same deduction as somebody that was out of pocket for these expenditures. In fact, there was an article in the Richmond Times-Dispatch this weekend pointing out that many small businesses and many minority businesses were not PPP loan recipients. And on top of that, if you look at on a national basis, and I don't have other than anecdotal information here in Virginia, but on the national basis, 50% of the PPP loans went to 5% of the companies. So that did not seem appropriate for us for this to be a proxy as to how businesses were impacted by the shutdown. Not to say some of them weren't. And some of them who got loans certainly were glad that they did, but they did get their expenditures paid for. Some who got loans were able to add employees, didn't actually need the loans. Of course, some that didn't get loans had to go out and borrow traditionally without loan forgiveness and not get the special treatment from the PPP. So that is how we came up with this. And I can tell you, when this first came about, and Kristen's on the line, I wanted to make sure that we were looking at this appropriately. I went back and had them re-look at, had we done the calculations of our revenue projections assuming this. So possibly there was no impact, but that was not the case because the act didn't come out until December 27th of this past year. We looked at different ways as to how we could look at this and be fair to all taxpayers. And I'll liken this, it doesn't always go this way. If you think back a couple years ago to the SALT provision, where we deconformed to that and allowed all taxpayers, regardless of what their amount was, to deduct the SALT, because we felt that all taxpayers should be treated the same. That helped. That was some of the reason in this where we came upon the recommendation and the governor's position on not to conform to this provision. I know that is not where the society is. I know Emily testified yesterday in that, but I want to be honest with you. I do not believe, and I was given there was a bill on this strictly on the PPP forgiveness. I was given the authority to say that the governor would strongly oppose, which means he would veto that bill. So I don't see this coming about as having this type of significant revenue reduction. So I'm not trying to say that to be negative. I'm just pointing out the politics of where we are. So that's how we came about and looked at this. Certainly, we would like to find a way to help those businesses that have been impacted by this. I do understand that many that got the PPP loans were significantly impacted, but quite a few that didn't get them were impacted also, and they don't get this treatment. So that is the reasons why. And Emily, I think that's pretty much bring us up to date. I want to thank you for, you've made clear the society's position, and I appreciate it. Usually most we're on the same side on a lot of things and like to find a way forward here, but also want to be frank with the where this is. It's going to be difficult to have this get through both the democratically quite frankly, legislature and with the governor. So that brings us to, I'd be happy to answer any questions. And I've got Kristen and June here to also join in the conversation.
Yes, thank you for that, Secretary Layne. We did have a few questions that have already come in via the chat, and then once we get through those, we can open it up to anybody else who would like to submit questions. So the first one is, if PPP revenue was not included in the projection of tax collections for the budget years, why is there any loss of revenue to the state, as this is found money?
Yeah, that is incorrect. We used the guidance by the IRS that was in effect at the time. Those loans would be forgiven, the taxes, but not the deductions to be taken. So zero effect. That's why I went through the base. So it is an impact. It was not included in our project. It was, we have a apples and apples comparison to our projections, and that deductibility was not included in them.
Then the other question that's come in via the chat is, do the deficits include the monies received directly from the CARES Act from the feds?
Received directly by whom?
That is the extent of the question as it's written. So
if the state received monies that had to be spent directly on COVID-19 expenditures, it could not be used for revenue replacement. So the answer is no. There was no offset from revenues in this with this bill. Those revenues that came to the state had to be used for qualifying expenditures and could not be used for revenue replacement. So they were not included in the revenues.
Okay. We have another question, which is, what is the likelihood that the conformity bill will not pass as emergency legislation?
Well, unfortunately, I think that probability is high. With the unless we can find a way to parse, I think the biggest difference relates to the PPP loan treatment, the loan forgiveness treatment. There may be a way to pull that out and then have conformity with the other provisions because other bills can pass with just a majority vote without the emergency. There's another way to put it in the budget. That again would get it passed, but would not be as quickly as I know that people on this call would like. The third option is that we could reach some agreement. I know this morning at the Senate Finance I was in front of, whether there's another way to give a credit to those businesses that were impacted, not so much just from PPP loans, but most significantly, if that would get the votes needed. Even if we put it in the budget or delayed it, if it looked like it was going to pass on a majority basis, the tax department, and Kristen, I don't want to get ahead of you here, but could give guidance that that's the way we were going to look at this year's returns. But of course, we could make no guarantees until it actually got passed. So it's long-winded to say right now, I would say that's a difficult situation based on not just the tax policy related to this, but the politics related to it because of the significant revenue impact. But we are looking for answers, and I know, Emily, you're speaking with our group this afternoon, and others. We're looking for ways to somehow reach a compromise so we can move this forward.
Pivoting slightly, how were Rebuild Virginia grants prioritized? This comment says, I had clients get funded versus other clients who had applied weeks prior.
Yeah, unfortunately, or unfortunately, I think it was pretty much first come, first served, just like the PPP loans were. Although I do know that a certain percentage, and I've forgotten the percentage, Emily, and because this was administered by the Department of Commerce under the Housing and Community Development agencies, but they did set a certain amount aside for minority and small loan businesses. I don't recall what that percentage was, but I do know that was set aside, a certain percentage was set aside for that. But otherwise, I believe it was first come, first served. In fact, we know we put we had 70 million, we put 30 more million You put another 20 million, I would expect we would put more there based on with some of the conversations I'm hearing in the General Assembly. We know that we could put a great deal more there and the need still exists.
Right. Okay. Next question is, when was the last time we were on the same side of things as referenced?
I think we're pretty much on the same side regards to having conformity come out quickly. I think during the Tax Cuts and Jobs Act, we reached compromise. I get it. We do have different fiduciary responsibilities. Mine is to the Commonwealth and the revenue and taxpayers treated. You're representing your clients and policy. Hopefully we can meet in between, but I understand sometimes that that's not possible.
Well, and I think I'll chime in there as well. I feel like, we always strive to be as closely aligned as makes sense with us both representing our different constituencies. So I think we agree more often than not. It's just that we've had a couple of higher profile issues where we're not fully aligned over this past year. When will the budget be voted on?
Well, if they stay, that has been an issue related to whether it's going to be a 30-day or a 45-day session. I don't think, just to give you a reality check, they're going to get done in 30 days. My guess is it's going to be in 45 days, which will put us into certainly well into the middle of March. Then the governor gets 30 days to look at the budget. They come back for a reconvene. So if everything lined up, I would expect by the end of April, if everything lined up. But I don't know that that's going to be the case. So it's not an ideal situation here at all. It's still going to be the majority of tax season underway or getting close to end by the time the budget would be passed.
Okay. Next question is, should revenue estimates improve? Would there be a rethinking of the PPP option?
I believe revenue estimates will increase. I do not believe that will change the recommendation on the PPP. I do believe it will give a greater opportunity to help businesses in other ways, but I don't think that there's going to be a change from the administration's perspective, not just because of the revenue impact, but because how other taxpayers are treated. So I don't think that would influence it. But I do believe we're going to increase revenues coming up.
Okay. Next question is, given the current state revenues, is the state breaking even despite the projected loss in revenues? So basically, how is our state faring overall?
The state is faring well overall. We are trending above the revised projections. The economy, and I can tell you that's three trends have happened over the last year. Large companies have done much better than small companies. Quite frankly, those that the large big tech companies, the people, the defense contractors, those that could work from home have done pretty well. And by the way, they have actually increased jobs, and the jobs created were at a pretty high level that have helped keep up our withholding revenues. And so we are trending better than anticipated in that. I'm not trying to minimize at all the impact of small businesses. They have been hit pretty hard, particularly the Main Street and leisure and hospitality, restaurants, those type of things have been hurt. The stimulus packages passed by the federal government in relation to keeping the consumer spending. Online sales are up 35%. Our traditional retailing is flat to off about 2%, but overall that is held up. So we are an anomaly. We're trending better. A lot of that has to do with our reliance on the federal government, and we in times of slow or very booming economics, we don't do as well. But when things slow down, we tend to do a little better because of a reliance on the federal government. So the overall the revenues are not what were projected back a year ago, but are trending better than where we thought we would be. Our projections right now are about $1.5 billion behind the original budget a year ago, but we'll be increasing that nowhere to that magnitude, but there'll be some additional revenue increases, I believe, coming up that the governor will recommend here in the next few weeks.
Okay. Next one is, I think I read that legislators are collecting a per diem despite being remote. Is that correct? And if so, what is the rationale if they are working from home?
I believe the House is collecting a per diem even though they're moving remote. I believe last I looked, the Republicans had said they would not collect the per diem. I think that's accurate. I do not have any other justification for that.
Okay. When it comes to conformity, why would the state not give individuals consideration for the medical expenses?
That's a great question. It's I would say of all the ones, that's ones that I've mentioned before we've been back and forth on, and certainly are willing to work with the General Assembly in that regard. As I said, the reason we did it was because we had deconformed last year, and that was the General Assembly's decision last year, and we left it where it was. But I have conveyed to both the Money Committee chairs that while we support the governor's conformity budget, that certainly we're willing to work with them and any items they see, and particularly that one right there. But that doesn't mean they're going to do anything. I just want to let you know that's why we put the conformity in where it was. We were deconformed last year.
Well, and if I could jump in on this one too, it was my understanding that prior to the Consolidated Appropriations Act, that was a temporary change, and it was the Consolidated Appropriations Act that made it permanent.
I believe that's accurate. And Kristen's shaking her head, so that is accurate. But again, like I said, that we left it that way because we were deconformed last year.
Okay. Any additional questions from the folks in attendance today? All right. Well, seeing none, thank you very much, Secretary Layne, for your time today. Thank you to Kristen and June as well for joining us to help provide information and insights. And I hope that everyone found this valuable. We will be sending out a recording of this session as we did with yesterday's, and we look forward to continuing to engage with all of you throughout the rest of this week.